Students, today I am going to discuss with you for CMA Foundation Course in accounting paper a topic called as joint venture accounts. First, let us try to understand what is a venture means. Venture means an activity, and in terms of business it will be a business activity. Buying and selling is an activity. Manufacturing and selling is an activity. So obviously, every business entity is created to perform these activities. There can be one activity, two activities, depending upon how many products they would like to bring. Now, business entities are created for running the business of their own, enter into transactions, and make profits. But many a times, the opportunity to take a business activity or business venture may not be that feasible because of limitation of certain types of resources. Maybe the business entity doesn't have sufficient financial resources, or it doesn't have managerial resources, or even functional resources like marketing capabilities, etc. So different business entities are possessed with different types of potential functionalities. Some are experts in marketing, some are very good in having a huge amount of finance, some have a brand value, by name they go, some are very unique in their manufacturing process. So each one tries to do business based on its own potential. But at times, there are new opportunities when you have a limitation of certain resources, but you have the availability of certain resources. For example, there is a demand for a product which I can manufacture very easily, very cheap, of a very good quality, and which will be acceptable in the market. But I don't have finance. I don't have money. Or I don't have marketing abilities. Or that product requires a company, whereas I'm in a partnership firm. I'm a sole tradership. So there could be various types of limitations the business entity faces. In such situations, it can join in hand with another business entity and to run that business, which requires all types of resources. The most important example for a joint venture, when two business entities join to perform a business activity, is a case when there is an insufficiency of financial resources. A, for example, has got 1,000 crores. B has got, let's say, 800 crores. But the requirement is roughly about 1,500 crores. So neither A nor B has got 1,500 crores individually, but to combine, they have 1,800 crores. So there is a scope of jointly doing the business activity. This is known as a joint venture. Obviously, this joint venture is business opportunity specific. So therefore, if there is a business opportunity, two independent business entities come together, form a business entity, and take up that business opportunity to share profits. Obviously, since it is a joint, there must be a legal contract, legal agreement between the two entities, two or it could be more. What are the terms of that agreement would be? How they will run the business, how they will share the profits, how much they will invest, who will invest, who will do the manufacturing process, who will do the managerial decisions. All types of terms are decided at the time of entering into a contract. But one very unique thing in this joint venture is that once that joint venture undertaken is over, is completed, maybe in 3 months or 1 year or 2 years or 5 years, the joint venture is closed, both the entities become independent, they take back whatever is left out in an agreed manner and then step off. A business entity can enter into joint venture with any number of other joint entities. It can be one joint venture, two joint venture, three joint venture. Obviously, a business will not try to have joint venture with a large number of other entities because managing a joint venture itself requires a managerial skill. Right. Another important point is a distinction that you should make between a joint venture and a partnership. Partnership is a permanent arrangement. It's a contract to do a business. But what business, how to do it, then nothing. This is the partnership. Any number of business they can do. They can do for a long period of time. If business is over, they can take up a new businesses. So partnership firm is an agreement to do a business. Which business is not the important matter. Though they may agree also which are the businesses, but that is not an importance. So whereas partnership firm is a permanent structure, has a permanent existence, and therefore the registration of partnership firms become legally meaningful, joint venture is a temporary phenomenon. It's a short-term arrangement. So it's based on simple contracts. You don't have to register as a partnership firm. Though many features of the partnership relationship comes like profit sharing ratio, business opportunities, who will do the managerial decisions, etc., etc. Having described to you what is joint venture, let's get into the accounts part of it. The two important points you must remember. One, joint venture is coming together of two business entities which continue to keep their business entities as it is. A is doing his business. B is doing his business. But for some unique business activity, A and B are coming together. They are not coming together for A's business or B's business, but for a specific business activity. So therefore, when we are talking about joint venture accounts, we should remember there is already a set of books of accounts A is maintaining in his books of accounts, B is maintaining in his books of account, and now there is a need to maintain books of accounts for the joint business activity. So joint venture accounts deal with this particular question. How are you going to maintain accounts of the transactions of the joint venture which A and B has agreed, keeping in view the terms of agreement between both the partners, co-venturers, etc. There are fundamentally two alternatives. One, if it is a too short a period, each business entity would not like to spend money on maintaining separate books of accounts, maybe maintaining a separate office and accounts people and all. They agree that, no, look, let us maintain our own set of accounts independently. Only joint venture account be incorporated in your books of accounts so that we can check up periodically whether we are maintaining the transactions without any gap, difference, and at the end of the thing we share the profits as it is. So when there are no separate set of books of accounts for joint venture business, the accounts relating to the transactions of a joint venture business are maintained by individual co-venturers. So one single transaction is being entered in both the parties. A, from his perspective point of view, because it is books of accounts. B, from his business perspective, because it is his business accounts. Take 2 or 3 examples. Let us say, for example, A and B contribute 10,000 rupees into the joint venture business. How they will record? In A's book, he will be opening an account called joint venture with B's account. It is similar to profit loss account, it is similar to capital account, and it incorporates assets as well as revenue accounts. Now once he has a joint venture with B account, it means any transactions entered into for the business. He is contributing capital, so his capital account will be reduced. So he would say joint venture account with BDR to capital accounts. Is paying out his bank. Joint venture account DR to bank. It's contributed capital. Now the same transaction in the books of B, what is the transaction? that a joint venture business has received a sum of 10,000 from A and he is contributing 10,000. So joint venture account with A account DR to A 10,000 to bank 10,000. His contribution to bank and whatever A has contributed be 10,000. So the transaction when A is booked, joint venture account with B DR to bank 10,000 to B account 10,000. Let us take an expense. For the purpose of joint venture business, an expense of 5,000 is paid. Obviously, there is no separate bank account. Either A will be incurring or B will be incurring. There is no common business accounts. So in the books of A, if A is incurring, you will say joint venture account with BDR to bank expenses. And in B's book, the same expenses incurred by A will be joint venture account DR with ADR to A. A is credited because the giver, receiver is a business, the expenses. So the joint venture account with B is the nature of real account, a nominal account, and even personal account of partners. Materials can be purchased. Whoever purchases, he will say joint venture account with other party DR to stock account. Alright. In other party, it will be A's account. So this way you record all the transactions. Joint venture account in both the parties will show all the transactions as it is. Profit will be calculated. Sales will be credited to the account. Purchases are debited to the account. Profit will be calculated. A in his books of account will say, if for a profit for his share, joint venture account DR to profit loss account for his share to B's personal account for B account. The same profit in the books of B will be joint venture account with A DR to A for the A share of profit to profit loss account for his own share of profits. So once the joint venture account is closed, in A's book there is a B account, in B's book has A's account. If you have understood double entry system till now, you know that both the accounts will show the same figure but is in opposite manner. If in A's book B shows a debit balance of 5,000, which means he must receive 5,000 from B. The same information, if all the transactions are properly recorded, in B's book, A's account will be appearing with a credit balance of 5,000. So they pay each other, cash DR to B in A's books, ADR to cash in B's book will close the books of accounts. Now this is possible when the duration of a joint venture is small. Suppose the duration goes for 2 years, 3 years. They usually keep a separate set of books, many time in office, construction activity, highway construction activity, all these types of big tenders are done in a joint venture. Joint bank account is opened. So whatever the co-venturers contribute, it will be joint bank account DR to A, to B. Now it is a separate business entity. A is our co-venturers. So if materials are purchased, it will be joint venture account DR to bank for purchases, for expenses to bank, joint bank account. If a particular co-venturer is purchasing, it will be joint venture account DR to the partner's co-venturer's name, A's account or B's account, if either they are contributing materials or they are incurring certain expenses. Similarly, sales, if sales directly done, so it will be joint venture account DR, cash account DR or sundry debtors account DR to joint venture account for sales. And if there is a stock at the end of the business, it will be, if it is carried to the next year, it's fine. Otherwise, it will be shared between the partners. So you will say A's account DR to B's account DR to joint venture account. That will close the closing stock. The profit will come. Joint venture account DR to A's capital account. Joint venture account DR to B's capital account. This will close the joint venture account. Now, what is left out? 3 accounts will be left out when you keep a separate books of accounts. They are co-venturers accounts, let's say A's account, B's account, and then joint bank accounts. After all the transactions are recorded, the co-venturers account will show a debit balance or credit balance. Those debit balance, they have to pay the money into the joint bank account. And the last entry will be the co-venturer's account whose credit balance is shown, their account DR to joint bank account will close the books of accounts. There could be some variations in these two types of accounts. Plus, there could be additional situations where specific arrangements are made in terms of contribution, in terms of sharing the profit, in terms of incurring expenses, in terms of doing businesses, etc., which we shall see individual sums in detail in our videos, Takshila videos on joint venture account. I'm sure this chapter can be easily understood if you go through those illustrations after explanations. Thank you very much.